Good evening, everyone, and welcome to the Kings of Capital webinar. Again, we have a very special guest this time around, as our objective has always been to give you clear, unique insights and help you make informed decisions about your portfolio, as well as help you make informed decisions about how people are running the business in the financial services domain. Today, a very special guest is Kamesh. Kamesh is to give a very quick introduction, the non-executive chairman and founder of the GoDigit group of companies, which comprises of the listed general insurance company and also GoDigit Life Insurance and ValueAtix Reinsurance, which is India's only private reinsurance company. Kamesh has over 3 decades of experience in the insurance industry, and prior to starting Digit, Kamesh was based out of Munich, where he was heading the group planning and controlling function at Allianz. He was also the CEO of Allianz India's JV with Bajaj, and he was the regional CEO of Allianz Asia Pacific. So thank you, Kamesh, for being on the webinar. It's a pleasure to host you. And you're one of the very few people, I was just racking my brain and thinking where individuals have created financial services businesses in India as first generation entrepreneurs. I could hardly think of anyone. Maybe Uday Kotak came to mind, but especially in the insurance sector, it's a first. So, from your thought process, given your experience of working in very different places, you started your career at a public sector insurance company, then a private sector insurance company, and then, of course, Allianz in various geographies. Given your rich experience, what prompted you to start up at the age of 50 and in the sector which is being generally crowded, complicated, complex, regulated? What was the thought process behind taking that plunge?
So first of all, thanks Tej and for having me, and good evening everyone. So I would first of all say no, I think this age of 50 etc. when you think of doing anything or something, at least in my case, I never really think about what age I am or not, because end of the day I think it's a bit uh, I would say irrelevant. I would say when I look back at the age of 50, I had already worked for close to about 25, 26 years. Financially, one was well settled. So maybe that was really the time to take risk if one considers this to be, taking a risk. I had already worked in a lot of places and both life and non-life businesses. So even from experience perspective, I felt that the time is right. And the reason why this idea came, one, I would say, is that insurance is a capital intensive business. So
Yeah.
unless you are able to have, people who are looking at this business from a long-term perspective and also putting in good amount of capital, there is no, I would say, there's no reason to really start this business. In my case, I think because of Fairfax, one had that confidence that you have a large long-term insurer who is willing to then commit to the venture for the long term.
Right.
Secondly, I think this was the time in 2014, 15, when a lot of these new insurance companies, the so-called insurtechs, were coming across, especially in China and US. And when we looked at their business model, it was more focused on one or two products. So one was return insurance by a Chinese new tech player, and it was home insurance for another one in US. Then some came in motor, etc., also a bit later. And what I think fascinated me at that time was that they were very customer journey focused. They were trying to improve the experience from a customer perspective when somebody is buying a claim or somebody is buying a policy or somebody is applying for a claim. And I think insurance companies can definitely learn a lot more from these sort of approaches. That was the first sense I had. The second was that while new products are good, but the real bread and butter in P&C insurance is typically in motor and fire insurance. small properties, etc. So idea was that these businesses you still need those classical technical skills, whether relating to pricing or underwriting or managing frauds in claims. So the idea was that is there a business model? Is there a way for us to marry the two approaches? So you still keep the classical part very robust, but you try and bring in more customer oriented journeys, both in onboarding as well as in the claims. And that is when I think this thought of starting a new company actually came. And as I said earlier, because I had a large partner like Prem Watsa who was willing to back the venture, I think that really helped.
Got it. And insurance is a business which has been in existence globally for now 300 or 400 years in some form, maybe longer. If you could, and still a layman thinks it's complicated, a customer thinks it's difficult for him to understand. If you could simply explain the business model for our viewers, that how does an insurance company make money, and where do you come in as Digit? Where have you tried to differentiate versus the rest of the industry?
Sure. So I think if you look at insurance, if you look at you're insuring 100 cars, for an example, typically 22 cars would meet with an accident. And if those 22 cars will take, say, just for the sake of argument, 100 rupees each to repair, then your cost of repair becomes 2200. So you have to basically spread this cost of claims amongst the 100 people. So everyone has to pay you 22 rupees as premium just
Right.
for covering the claims. And then on top of that, you have to add the cost of distribution, people who will take the insurance product to the end customer, and the cost of running those business, which we call as management expenses. So this typically is what a insurance model is, where you are trying to diversify the risk of few amongst many. If you go to health insurance, you will typically have about 8 people taking claims out of 100. If you look at two-wheelers, this could typically be about 10% of people, two-wheelers will meet with an accident, and so on and so forth. If you look at fire business, then less than 1% of the units you are insuring will actually have an incident of a fire or a flood. I think what makes this business slightly more different than other businesses is that you are basically looking at long-term trends for the pricing, and these trends could be 10 years, 20 years, 50 years. If you're looking at, say, exposure of earthquake, earthquakes typically happens one in 20, 25 years. In a country like India, in some countries, it's much more frequent. If you look at rain patterns today, especially in the last 2 years, 3 years, you will notice that a lot of cities, like recently, I think on 30th of September, Kolkata saw in one day, in 24 hours, rain, which typically happens in the whole month. And this was the trend in a lot of other cities in India. Now, this typically immediately leads to urban flooding because when so much rain takes place in a short time, the water has nowhere to go. We saw this last year also in places like Italy, for an example.
Right.
So, typically, what you actually start seeing is that some of these weather related changes are very difficult to predict. And how do you really price long tail business or long risks like earthquake or floods when the pattern is changing, so fast? The second area which we saw post COVID was a lot of the developed countries had practically very less inflation. Inflation was close to 0% in Eurozone, and in US, etc., it was more close to 2%. And then in 23, 22, you started seeing this surge in inflation. Now, if you are looking at cost of repairs, whether it is homes, shops, or vehicles, or even healthcare for that matter, you were expecting, looking at last 5 or 7 year, the trend line, you are looking at inflation of 2%. Now suddenly you have an inflation of 8%. And you will see because of this sudden surge in inflation, insurance companies suffered some losses. So typically the business is that while it is long term in nature, but in the short term, you are seeing some sort of a volatility. So you have to also anticipate how some economic changes on the macroeconomic side or now from a global, I would say, macro perspective, how they could increase the or how could they impact the claims. One example I'll give is I think when this Russia-Ukraine war started, and suddenly movement of ships through Black Sea became a bit of a problem, and ships had to take a longer route. Now, if you're insuring goods which are going from one country to another, suddenly the duration of the travel has increased by 2 weeks or 3 weeks. So not only you have a risk of the ships getting damaged, but you also have now enhanced exposure because of the longer route. The ships are more on the sea than they were supposed to be. So these are kind of things which typically happen. Health insurance, we know what COVID did to the health insurance claims. So all I'm trying to say is while the business is 400 years old, the pricing and classical models are very stable. But now we have started seeing more and more these sudden events which impact the business a lot, and they are completely unanticipated. And that makes our business slightly more complex compared to other industries.
Right. And where does Digit come in terms of differentiation versus what the rest of the industry was doing? What you thought is the missing piece, or where you saw white space where you could differentiate?
Sure. So I would say broadly three things. One is, I think if you look at in 2017, when we were looking at consumer court cases consumer in India, if I remember often, more than 40% of the cases were pertaining to insurance company. So we felt that there is some sense of trust deficit between the customers and the industry. And the idea was that can we try and become more transparent in terms of what we are doing so that customer becomes, we can try and build more trust with the customers. We started publishing something called as transparency report. We still publish it every 6 months, where we give a lot of consumer related data, whatever people ask for, just to tell them as to what's really happening uh, uh, with our service as well as with the claims. And I think the last issue came in November, which covered April to September, and it's available on our website and all social media. It gets very wide coverage. It's read in more than, I think, 75 countries across the world. So that we try to make a change as much as possible, also with the business partners, where they could actually see how the commission is, where if they have put in a request for a service, where exactly the service is. And this is something which we have to keep pushing the needle more and more. So it is not something where we can clearly define and say, we reach here and that's it. It's like something you have to keep pushing the needle. The second was we try to simplify the products. And why simplify? And again, there are videos available on our website and social media where we try to simplify the language of our products, which a 15-year-old could understand. And the idea was that with each product, we send a two-pager, which basically captures what is covered, what is not covered also very clearly in simple language, and what the customer would need at the time of claim. So that was one. We also tried to change the way the product is structured so that it becomes more meaningful from a customer's perspective. One of the earliest products where we had focused a lot more was in case of travel insurance, where we came out with this delay. Till that time, insurance companies would cover delay of 6 hours in the flights. And when we looked at the data, we realized less than, I think, 0.5% of the flights get delayed beyond 6 hours. So we changed that to 45 minutes or 60 minutes. We made the claim process completely different, where we would track each flight and we would inform the customer that your flight has got delayed and you are eligible for a claim. And a lot of other changes relating to baggage and some of these areas. In mobile insurance, we try to do the same, where you could buy a cover for whole mobile only for the screen and things like that. In motor insurance, we came out with you could upload the photos and we could pay a claim directly. So In each area, we try and we continue to try how do we simplify the product and the process so that both understanding of the customer and the claim process becomes better. So that was the second area. The third area, I think it was more distribution or the business model oriented, was that we came out with this API-led structure where distributors were becoming more and more bigger, and these brokers and corporate agents could work with more than one insurance company. So idea was that how do we build a service framework, a tech framework, in which the services to the partners could become much easier. And we said that we'll try and empower all our partners to do what typically happens in a branch of an insurance company. And just to give an example, previously people will have to come to the bank branch, to the insurance company's branches to deposit premium. We actually tied up with banks, and our partners could go to any of the bank branches with which we tied up with and deposit the premium, and it would get reflected on a real-time basis. So you try and make life easier with the for your distribution partners so that they can focus more on selling and less on the administrative stuff. So these were broadly three things which we tried to do. And in simplification, one also thing which we had decided was that we'll not enter into any channel or any product new line of business until unless we can find some way to differentiate ourselves. So idea was not to be present in every single product and every single channel until unless there is something different which we could do. So that was broadly the philosophy. I may add that I thought that when we started with this, that this is something which will get over in 3 years. But I think as you start digging more and more, you start seeing more clarity as to how much more can actually be done in this. So I think this journey really continues in Digit.
Right. Typically when we see in financial services, especially when a new entrant tries to enter, whether it's investing, whether it is lending, whether it is banking, whether it is insurance, we try and see a new entrant try and disrupt the industry, which usually means you end up taking more risk. But what you are suggesting is you've not tried and disrupted things, you tried to simplify things rather than take more risk and disrupt anything. And that is also visible in your underwriting numbers, underwriting triangles, resolving triangles over the years. So, how is it that in an industry where there were so many players who were well entrenched, you've tried and built something, you've already got to 5 to 6% market share in motor, with resolving triangles which are showing that your underwriting is best in class? This typically doesn't happen when we've seen things in banking pan out, lending pan out. You don't see a new entrant having, say, NPA numbers which are better than HDFC Bank. But somehow you managed to do that in insurance. How and what's the sort of science behind that or art behind that?
So I would say I think two things. One is that while Digit was new to insurance, I think we have an amazing team, and they have been around in this business for a long time. So while the company was new, we actually had team which was, I would say, as good as any, if not better than what was there in the market. I think the second big advantage which we had was that when you are trying to do very granular pricing or rule-based underwriting, you need very robust technology systems. And since we were starting from scratch in 2017, I think we spent huge amount of time and resources in trying to build a platform which can enable us to do this sort of a very granular pricing and underwriting. And later on, obviously, this started moving towards claims and fraud framework and stuff like that. So I would say these were the two areas, having a great team and then investing a lot. I would say even over invest in the tech platform. We decided to really go in this area. And one experience which I have across industries and across countries is that everyone has data, but everyone doesn't use the data. And while people find this strange that how one company in insurance is having different loss ratio, but this is true across the world. Even in your area in investment, for listed entities, everyone has access to the same level of information. But show me two fund managers who have the same outcome. So having information and use it are two different things. Having information and use it in the same way as everyone does is not really practically feasible. Different people make different sort of, I would say, interpretations with the data. And in a very homogeneous market like Singapore, if you look at the best motor insurer as an example, and the average loss ratio for motor in the industry, even in a homogeneous market like that, I don't have the latest information, but it could easily have a loss ratio difference of 4 to 6%. In bigger
Right.
countries, bigger markets like Italy or UK, or I'm not talking about US, Germany, you could even see a difference of about 8 to 10% in the loss ratio. So I think, how do you bring this into the culture? Then how do you get your salespeople who are actually on the ground, who have to drive business, to be focused on what kind of a business they should write and what sort of a business they should avoid? So, because any distribution strategy then also has to be executed on the ground. And if you can't convince your own sales colleagues and your distribution colleagues, then partners, then it becomes lot more difficult. So it's a more like a holistic approach rather than just, I would say, no one person or one team who is able to pull this through.
Right. And now it's been about 9 to 10 years since you started out. Versus your initial expectations, what would you say has been, a pleasant surprise where you thought it would be extremely difficult and it's turned out to be, say, easier than that, or you've been able to pull off something which you thought was difficult? And what do you think versus your initial expectations has been more difficult to achieve? You would have thought that this is something you would have wanted to do, but it turned out that it's not that easy in a market like India.
So, Tej, we have just completed about 8 years since we issued our first policy. So, initially, I think, and all this is in hindsight,
Yeah,
I
of
think
course.
when you are starting a new company, nothing looks easy, honestly, because it's a daily struggle in something or the other. But when we look back, I would say I think we got some easy way to enter into motor insurance, which was third party, which was something industry had not focused on. So first 3 years for us were really easy from that perspective. After that, competition has been extremely intense. Secondly, I think when COVID came, we were heavily motor dependent at that time. And motor business obviously took a bit of a toll because when you have a lockdown and things like that, people don't drive, new vehicles are not getting sold. But I think we could come out with the COVID related products and different versions of it. And I think that gave us massive reach with the corporate customers. And now it could also position Digit as somebody which is very innovative, could come out with new products which no one else in the market was able to do. It also taught us some great lessons in terms of how do you price completely a new product, and also then look at assumptions, actual versus assumptions on a very intense weekly basis. Uh, so how do you really build those risk frameworks in the so-called unknown sort of a risk? So I would say I think when we look back from that perspective, first 3 4 years, it seems we got an easy ride when looking back. After that, I think each of those niches which we were focused on, people or other companies try to focus on those a lot more, and then we have to move to something else. So if you look
Yeah.
at last 3 years, our growth in non-motor business is substantially higher than motor. And we started seeing very good traction in, say, corporate lines of business and others. So in our business, at least my understanding is in a market like India, which is very dynamic, that you have to really be agile and very flexible in terms of what channel, what geography, what product line you want to focus on, because market dynamics can change very fast. So if you bind yourself on yearly plans and things like that, that can make it very difficult for you to then then evolve in a manner which you position.
Right. And from your vantage point, having seen the last 8 or 9 years, what's the plan for the next five, or what's top of your mind right now?
So I would say I think life or business is like a roller coaster. So I think I personally don't worry about high competition intensity or low competition intensity. I think a good thing about our business is anyone who wants to grow, they will need capital because that is what the solvency margin requirements are. If you look at profitability of industry, a lot of players don't even give a double-digit ROE despite being around for 15 or 20 years. So most of them could not get to a decent size. If you look at some of the bigger companies, some are not able to grow as much as in terms of market share what they had a few years back. Some have seen challenges in terms of TP loss ratio and had to strengthen reserves. Um, so I think all I would say my personal, if I have to just say one wish, is that more and more companies should get listed. Because I think when you get listed, then there is like, if you look at banking as a sector, there is a minimum level of, uh, I would say, reasonableness in the actions of different managements. In case of insurance, very few companies are listed. And this obviously makes the industry, more prone, some players more prone to being rash. So if I have to give an example, this is like you're driving on a highway and there are 20 drivers. 4, 5 of them are reasonable, but 15 are rash drivers. On the other hand, you're on the same highway with 20 drivers and 18 of them are reasonable and only 2 are rash. So
Right.
I think we would prefer to be on a highway where most of the drivers are reasonable rather than rash. And that reasonability can only come when companies get listed.
Yeah, I think that's a great analogy. On that note, Keshav, over to you.
Can't hear you, Keshav. Can't hear you. Maybe are you using a hands-free or something? No,
Okay, I
not able
think
to.
Keshav's mic has an issue. I'll take
Hmm.
over. So
Sure.
on your management and review style, what given that you manage multiple lines of businesses, what is your review style, level of delegation to the team? How do you manage the business? Given there are multiple metrics you can focus on, you can focus on being a contrarian, you can focus on competition, and obviously you can focus on innovating. How do you manage the business as a whole and manage stakeholders, given you have shareholders to take care of, employees, and the channel partners?
Sure. So one I would say, Tej, is that I think we have CEOs of each of the businesses. And if you look at our non-life company, we also have then a lot of profit center heads.
Right.
So if you look at non-life business, I think the company is driven by the CEO more on the ROE basis, keeping in mind loss ratio and the combined ratio also. I don't want to dwell on the combined ratio, but I think Indian combined ratio has no real correlation with the profitability. So we look at more IFRS results on that basis. And in our case, there is a very granular way in which business is seen from ROE and a loss ratio perspective. So you have profit center heads on one side, you have product heads on the other, who basically drive the profitability. And in a way, both of them are responsible for the top line and the bottom line target. So it's not that the sales people are only responsible for sales and product team is only responsible for the loss ratio. I think both of them are really driven around this. Then you also look at various other areas in terms of distribution as to how concentrated your distribution is, because our objective is to have a very diversified and fragmented distribution structure and not have dependence on a few large distributors, irrespective of how big they are. And then the third is that we obviously by nature try and look at opportunities where we see market not being interested or less interested, and try and avoid areas where we see feel that market is very enthusiastic about it.
Right. Got it. Keshav, is your mic okay now?
Yeah, can you guys hear me now?
Yes,
Perfect.
absolutely.
Yeah. Kamesh, it would be good to understand, as you said, you started, as a motor company largely, and within motor, it was largely, I think, CVs. But over time, you've diversified and entered into new products. It would be good to understand what goes behind the curtains when you enter a new product. For example, today you are sitting out of retail health, but you have talked multiple times that, it's a perfect storm, which is brewing in the industry. So what is the final thing that you need before pressing the buzzer? When you want to enter a new product line.
So, Keshav, I think when we go back and we look at motor, I think if you look at analyst, because I think I always try and look at where the money is flowing,
Yeah.
because that is the best way to look at what the companies are really thinking in terms of strategy. So, if you
Mm-hmm.
look at analyst reports at that time, everyone was focused on private car business.
Right.
Nobody will speak about CV.
Mm.
And when you look at the profitability at that time of the third party business with the rates increases every year, etc., we felt that the big opportunity is more on the third party side. And obviously, as I said earlier, 3 years later, when and after that also, there has not been a meaningful increase in third party rates, but more and more companies have become aggressive on third party business, commercial vehicle business, and now maybe some of them are again pulling back a bit. If you look at retail health, it was like flavor of the season. Everyone wants to be in retail health and others. And when we looked at from our perspective as to how profitability of this industry would be, we couldn't figure out how this business could be a 15% ROE business on a consistent basis. I'm not saying any business is good or bad. I'm just saying that from our perspective, how did we try to do that? And again, as I said during our October investor call, uh, if I go back to 2020, 1920, 2021 also maybe 1920 specifically, commercial vehicle was, I think, 60% or 65% of our motor business, and motor itself was about 70% of our total business. So more than close to about 50% of our total premium was coming from commercial vehicles. Now, within motor itself, commercial vehicles is the smallest segment now. Two-wheeler is bigger than that, and private car is the biggest. We had also focused from day one in fire business of large industries, because at that time the premium rates, if I remember, it was called as M12. So for 12 occupancies, there was the premium rate was better than everything else. And these were large industries, so you needed good reinsurance capacity. So we created capacity and only went for this business, and later on we expanded towards SME and other areas. So I think this is something which, again, you have to do on a consistent basis, because, as I said earlier, the market dynamics can change. But what we definitely try and do in our company is that at all times we are trying to build more and more capabilities, because we don't know which business will become attractive or unattractive at any point. But idea is that if we have the capability to manage this business in terms of underwriting, pricing, and claims from uh, the whole tech platform perspective, and we have the distribution in which we can reach out, then when the time comes, then you can try and scale up the business. So this investment and continuous investment in building the capability is something which we do a lot.
Right. And specifically on retail health, if I may ask, given the intense, competition as well as the losses that we have seen over the last 24 months, do you foresee an opportunity coming in, or are you still willing to wait out?
So I would say, Keshav, I think it's like your business is similar to ours. You can't get the bottom or the top always right. So I think you start trying to wet your feet when you feel that maybe the bottom is coming,
Hmm.
and you start then saying that I'll start building it, the positions now. So I personally still feel that I think retail health could see another 12 months of pain, more to come from a regulator's perspective, because
Okay.
I think if you look at, again, whatever I read, I don't have any internal information per se, that the complaints and all haven't really reduced from a customer's perspective. Now, every day you hear some or the other stories, and obviously these are exceptions. There are a lot of claims which are settled also. But I think the product structure, etc., I personally feel can be simplified a lot compared to what the situation is today in the industry. So I think our teams have started looking at this business a lot more seriously. I think some more work is going on in terms of getting the product structure and the underwriting framework better. But I would say that I think um, our colleagues have started maybe exploring areas in this. I won't really say that we are building this, etc. But because when you are not very enthusiastic about a certain space, then obviously you will put a lot of guardrails. And those guardrails might not make it attractive from a distribution perspective. So what typically happens is when other companies also become more conservative and they also start putting in guardrails, then you start getting the business flow, to your side. So my sense is we are still some time away from that.
Got your point. And you touched upon, regulations. One of those regulations that all have been waiting is composite license. It was, I think most of us expected it will come in, but it hasn't come in the Insurance Act, which has been recently passed. But your thoughts, does it make sense if the regulation come through? Because you are one of the very few, who has a, fairly fresh company in all three. So I'm assuming your systems and processes, you can guide them in the way you want. So integration becomes far easier other than, most companies have legacy systems. It makes far difficult. Does it make sense from an economic point of view to have a common company have a composite license and to select products maybe both on the life and non-life side, as well as reinsurance maybe, given you have businesses in all three now?
So I think the insurance amendment bill has been introduced today in the Lok Sabha.
Hmm.
Whatever I could understand is that composite license. So my understanding of the amendment is that what basically government has tried to do, which is very positive, is that otherwise in insurance we are the only sector where every major change had to go through a parliamentary amendment.
Right.
No other sector it actually goes to parliament. So what government has done is they have proposed a lot of amendments where IADA in almost most cases, and in few cases, government can actually decide what how the sector can actually be driven. So my understanding is that the act permits the government to define a new line of business, and the new
Okay.
line could actually be a combination of businesses. So if the bill is passed, according to my understanding, and all this is like today's development, so though I have also read one or two people who have said, some journalists, that it has not been allowed. My understanding is that almost all the amendments which were discussed in the past, all proposals, they are part of this amendment bill. So composite should also be allowed. Now, answering to your specific questions, I would say the balance sheets of life insurance and non-life insurance companies are slightly different,
Okay.
because life you have much longer tail of risks compared to non-life. Secondly, in life you have more investment risk and less uh, mortality or morbidity risk, while in non-life business you have more underwriting risk and lesser investment risk. So balance sheets are very different. But if you look at it from a distribution perspective, there are obviously a lot of synergies because more and more distributors are engaging in both life and non-life. So I would say that having one company, but running it like two different balance sheets, one for each business, is probably the right way to look at this business. And once the regulations and all this framework comes for the composite companies, which could be, I don't know, 3 to 6 months away, assuming the amendment gets passed through the parliament this week, then we will definitely seriously look at the regulatory framework to say whether it makes sense for us to know or not. But till the time detailed regulations on solvency and all of that actually comes through, I would say it will be a bit premature to say that it will be good or it will not be good.
Got it. Got it. And one last question from my side. And if I were to zoom out, if we look at geographies in the US or UK, we still find companies who kind of deliver 20-25% ROE in the general insurance space. In India, very few companies on a sustainable basis. Now, one could argue the accounting is, accounting depresses the reported profits in India's case. But there is also, a lot of capital that comes in because since it's a growth market. But beyond accounting and growth, do you think something needs to change for the industry for at least quality players to start reporting better ROEs rather than a handful, maybe one or two, barely touching 20% ROEs, whereas in the West, we have seen many companies kind of deliver better return on equity outcomes despite the underpenetration that we have in India?
So I would say, I think under IFRS, that growth factor is really taken out. And
Right.
when I'm saying IFRS, I'm not looking at mark to market change in investments because insurance companies are long term holders of investments. So quarterly changes in mark to market is something I would ignore. So what we do internally is to look at the Indian profit. And I think we showed this also in we show this every quarter in our results. Then
Correct.
we add to that the change in deck.
Yes.
Because deck is something which is the profit which you will earn most of it in the coming 12 months. And then you try and say that if you have IGAP profit plus you have deck, then you take out 25% tax out of it, and then you calculate your ROE. So in our case, you can
Yeah.
see there is a decent difference between the two, IGAP, ROE, and IFRS. So my sense is that over a period of time, companies typically take 10 years, 11 years to build a decent AUM, investment leverage. And I think as more and more companies get listed, Keshav, I think the overall profitability of the industry should improve. Today, you have to keep in mind that we have um, four government companies which have almost one-third market share.
Yeah.
Three of them don't even meet the solvency margin.
Yeah.
Then you have a lot of other companies which are, as I said earlier, not even in 8-9% ROE range. So you have certain players with a market share of roughly about 40-45%, which are actually working on very, very low ROE. And this obviously drags down the ROE of the whole sector. So last year, I think regulator had tried to push a lot of companies to get listed. And my
Right.
sense is that this is something which should definitely be done because uh, this is the only way some sort of a minimum discipline and underwriting which will come. But
Yeah.
over a period of time, you'll anyway see that polarization starts happening in the profitability and growth of different companies. And if you look at a lot of companies which came in, say, after 2005, 6, very, very few of them have been able to build a decent scale and also profitability. So that sort of a noise is obviously there. But I think my understanding is in the medium term, we should move in the right direction as an industry.
Yeah. No, listing of players should definitely increase the scrutiny on some of
Absolutely.
the players that have kind of been doing naughty stuff. No, great. Over to you, Tej.
Great. So, folks, we'll take in questions. If you could put the questions in the Q&A box, we'll start taking in those questions. Kamesh, before that, what do you have as in your mind as the end state for Digit? Say 5 years, 10 years out, would you have financial metrics in mind? Would you have relative versus industry metrics in mind that you would want to deliver, or that mean for you that this company is successful?
So, Tej, I think if you look at any insurance startup anywhere in the world, including US and China in the last 10, 15 years, I think in 5 years we reached close to $1 billion in premium. Under IFRS accounting, international financial standards reporting, we achieved a break even in year four, if I remember, year three, and accumulated break even by year five or six. So I would say, I think, at least to my knowledge, I not not any other company has been able to achieve this sort of a top line and bottom line. So the way I think we see this is that we have a very strong foundation uh, of Digit. You also said that we also now in life insurance and reinsurance. So if you look at in the last 8 years, our three companies put together have invested close to about 6,000 crores of equity capital out of total of about 85,000 crore. So my sense is we probably will be the largest equity investor in the insurance sector in the country.
Right, right,
So I think when I personally see it from all that perspective, I feel that insurance is like really, really a long-term business. We have that unique position where we are the only group which is across all three lines of business, including reinsurance. We have a very, very strong foundation. Now the question is how tall a building you can build on this is in the hands of all of us. So for me, I think I only think of building a building which is bigger than Burj Khalifa on this foundation. So idea
right.
is that we are still building the foundation. I honestly have no personal goal as such. I think I've been extremely fortunate, maybe one in a million sort of a person who starts working from a public sector insurance company. Never in my life I thought that I would have my own insurance business. Now we have been fortunate with my colleagues to start three insurance companies. So I just see this as my job is to just keep working and keep doing my best. And we have a very strong team, as I said earlier, and they have to take this forward. I don't really have a goal. I don't think that at this stage I'll sell out and then relax. And I think till the time God's decide me to retire, I'll keep working. That's the only thing which is in my hand. The day he decides or she decides that, okay, I should retire, which means retire, then there's nothing to think about.
No, absolutely. I think it's a fascinating story. And the fact that you've been able to get Prem Watsa on board, I think it's a perfect match, given his experience, given what you were trying to build. For me, also, it was good to know that you were actually the largest equity investor in this sector. So in the
Absolutely. I think we have put where our
that
mouth
speaks,
is.
absolutely, that speaks volumes about our commitment to the sector and
Yeah.
the potential that you see.
And Prem is someone who keeps asking me what more, what more. So he's not retiring at 76. So I'm at 59. I can't even think of doing any of this, and I have anyway no intent to retire. I don't know what will I do if I retire.
Right, right. So on that note, we'll start to take in some questions. So
Sure.
Krushi's question is, if you could help us visualize how do you internally go about entering or focusing on a product line? When you start or decide to enter a product, what are the strict do's and don'ts? Where does your judgment come in? What does the team do? How much is it gut versus data? How much is it contrarian versus market trends? What goes on internally when you start to think about a product?
So I would say, I think when we look at, say, motor business, and I'll give two examples, so hopefully it'll become more clearer. So when we look at, say, fire business, and I spoke about M12, etc. So we actually took a very seasoned guy from the industry who was also an ex-colleague. And we went through data together to say that which size of risk is like, no, above 1,000 crore, above 2000 crores, sort of a sum insured, less than 100 crores. How was the rate looking at? And we felt that if we look at risks above 2500 crores, and I'm talking about 2017, and these 12 occupancies, which were called as M12, the risk reward matrix looks the best because you need large capacities, these are big risks, and there is an understanding from a reinsurer side, underwriting guidelines, which says that you should not be charging below this rate. So then we said, okay, this looks most attractive. From the distribution perspective, this business comes more from the brokers or the direct corporates. So you don't need a very big distribution uh, channel or network for you to reach out to these clients, because all you're talking about is 142 risks at that time. So we said, okay, all we need is create the reinsurance capacity because we have people who understand the risk, so we'll be able to underwrite looking at these 142 risk, whatever we want to underwrite. So I think when we went with this methodology, then the question obviously became, why would a new company get a large reinsurance capacity when nobody else did? And we also wanted more freedom in terms of how to underwrite risk. So there we tried to figure out from our side in discussion with the reinsurer to say what makes sense for both. So we tried to design a reinsurance treaties in a way where we could be a direct player, we could also be a reinsurer. So there was no, I would say, advantage or a disadvantage from any position. So you could be on either side and you would be okay with that approach. And that I would say, when we look back, I don't know how it came to the mind, but we realized that if we don't get that reinsurance capacity, then this we would not be able to tap. It worked well. Touchwood, all our reinsurers who started with us, they continue with us. A lot of them also moved on the life side. So I think it has worked well, and our reinsurers, I'm very happy to say that looking at our overall results, they're very happy with it. Now, the way we had restructured our treaties in the last 4 or 5 years, other, especially bigger players, also tried to move to that sort of a structure. Now, why we could see this opportunity and others not, I honestly don't know. But people still are not moving whole hog in the spirit of that you could be on either side. So there again, we are fairly unique, and that also explains why we get the most flexible, treaties where we decide what the underwriting is. I think if you look at another example, which is essentially COVID, where there was no data and you were still coming out with a product, and basic pricing in COVID health insurance was incidence, what percentage of people are likely to get COVID, and what could be the cost. And initially, this was a defined benefit product. And as we started developing this and picking the data from Italy, and there's a epidemiologist in an Indian lady in Boston, IIT Kanpur came out with the model. I think Indian Council of Medical Research was continuously then coming out with data. So you have a basic data model, and you're putting in more and more data every week. So we started with a defined benefit product. We realized that we have made mistakes. Within 6 weeks, we changed the product design. And then we came out with 4 different variants of a COVID product. Because I think from Italy, it became clear that people who are older or who have diabetes or this pre-existing conditions, they are more prone. So as the more and more data was coming, we were actually revising our assumptions. And then the Delta wave came, and then we saw everyone withdraw from the market, people who had followed us in this product. And we went back to our model. We actually also built that, okay, now vaccination has started. What are the sero surveys saying? So all this data, and we would take a decision that, okay, let's continue for one more week. Let's continue for one more week because things are still within our model. So the call you are taking is how much capital is at risk And can you afford
Right.
for one more week, afford for one more week? And I think for us, if I distinctly remember, April, May was the toughest period in 2021 when the hospitalizations were shooting through the roof. The Delta wave, you might remember, was very bad from a hospitalization perspective. In November, December 20, average hospitalization period was 7, 8 days. Here, the average hospitalization days moved to 17. A severe shortage of oxygen in patients because no virus was very severe. And then we started actually seeing those numbers come down as vaccinations went up, and also sero survey, which was showing that 75% of the people were anyway infected with the virus. And the second hospitalization case in COVID were very rare. So,
Right.
so the idea was here there was no data, but you build a model, you keep populating. But when we were doing I would say in later part of early part of 22 or later part of 21, when Omicron also wave happened and that was built into our model. We had built a model every 6 months that the wave could come. And as vaccination increases, then this should die down. So Omicron came, it did not lead to hospitalization. But God forbid, even if it led to hospitalizations, we would have still been okay from our model perspective. But then it turned out to be a great decision because it did not lead to hospitalization. Overall loss ratios then turned out to be much better than what we were prepared for. But when we were analyzing this, I think, and this was a mistake, I would say, on my part, is that some data was available for Spanish flu also, though it was more than 100 years old. But I think what skipped our mind completely, though we were reading about Spanish flu at that time, was to say, we could have done some search on this. Not in terms of how it will spread, because communication today's world is very different when it was 100 years back. But we could have picked up some models. But some great work was happening. And especially as I said about this, our Indian lady who is in Boston. And there were a lot of podcasts which were also happening. And we went through this zero survey reports of 22 cities. I read them like line by line. If I
Wow.
if I remember that time, I would be spending 8 hours every day sitting at home or wherever one was, just reading every single COVID data. And
Wow.
this data I would even remember now as I'm talking. So 22 cities in a place like Pune, the Zero survey was saying at random when they were testing 100 people, 78 people already were carrying us COVID virus. So when large proportion of population was carrying the COVID virus already and they were not hospitalized, then you know that the chances of hospitalizations will be less. But
Right.
last lines, I'll say all this sounds very intelligent in hindsight, but when you're doing it, it was scary as hell. It's like
Yeah.
one would not be able to sleep. So I don't want to present this as a very glamorous side. It was terrible
Mm.
to go through. I just hope next time when some sort of a crisis happens, whether due to climatic change or something, we still have the learnings of this from this, and we'll have more emotional quotient to go through that hurricane, of emotions which you go through in a crisis.
Mm. Got it. Well, that's very interesting. Sayed Jain has a question on, the FDI, 100% FDI regulations which have come in. Related to that, he's asking, does that mean there will be more capital coming into the sector and more insurance companies coming in? Or do you foresee that consolidation in the industry will continue to happen?
So I think my sense is that at 74%, anyone who had to come would have come. Some
Right.
specialized insurance companies, might find 100% more attractive. But when we look at broader financial services, if we look at banking and mutual funds, asset management, which are significantly larger than insurance as sectors, you would actually see that the share of pure foreign kind of either asset managers or banks is continuously reducing. So I think as a sector in financial services gets mature, more and more. In bigger economies, bigger countries, you actually see the local financial institutions doing much better. If you look at US, how many foreign banks, and we know some of the really big foreign banks, whether from Switzerland or Germany or Netherlands or UK, what have they been able to make out? Similarly to what some of the biggest American banks have been able to do, say, in continental Europe.
Right.
So my sense is that some capital would come, but will this fundamentally change the sector? No. Somebody like us, whether we are losing sleep because of 100% FDI, not really. This is not
Right.
even in the consideration zone from a strategy perspective.
Right. Got it. There are a couple of questions which are topical about AI. What is your dependence, or what are you doing on AI? And I'll club that with a question from Varun, who's asking about your technology platform and how is that different from the rest of the industry.
So I think in terms of technology platform, one, I would say in 2017, when we started, we were the first insurance company 100% on cloud. So this was obviously complex at that time, but it helped us to scale up as the company scaled up. Secondly, I think we came out with this microservices sort of a architecture, which was relatively new at that time, where you have an insurance score, which in our case belongs to Allianz. But we developed a lot of these microservices ourselves in-house, which is our own IP, which is integrated with the core. And I think that turned out to be a great decision from a design perspective. And later, if you look at even on the cloud perspective or infrastructure, last 2.5 years, we have moved to this managed services sort of a thing, where we use the cloud for storage, etc. But all the services in this, which are run to manage a cloud, we have actually brought them in-house. We have not kept it with the cloud providers, so that we have independence, and if need be, we can move from one cloud to another going forward. On the AI front, I would say, if you look at our last year's or even our RHP, etc., we have given some very concrete examples on reading documents in various languages, something related to image, etc. I think now the usage is also around developing our own software, because we have a fairly large development team and data science team, etc. We are trying to use more and more of that. Unfortunately, being listed, they will not be able to share anything specifically, which we have not shared with the wider investors, etc. But I would say maybe one data point here, which could be relevant. If you look at our management expenses, that is the amount of money we spend on managing the premium. I think the first example I gave of the basic nature of insurance business. I think our management expenses, despite us being only 8 years old and not at a full scale in terms of premium, etc., we are actually industry's best here. So all I can say is that a huge role is played by technology and the way our business model is in achieving this sort of a result, in a fairly short time.
Got it. A question from Anusha is on what is on your reserving philosophy. What is the margin of error that you would have over there? And I add in something which is related to that is in India, we've not seen a very deep insurance cycle. Like if you look at motor OD, it's been sort of a soft cycle now for 15 years. We've not seen any sort of large catastrophic loss, unlike what we would have seen in the US multiple times over the last 100 years. So do you worry really about those long fat tail risks, which actually the industry has never seen? But if you speak to investors or insurance professionals outside of India, they would think of this in terms of 20 or 30-year cycles, where they would say India has never seen a cycle like that. So how do we know where does the insurance industry stand really if it's never seen a cycle?
No, I would say that's a wrong statement, and let me explain why. So, if you look at motor claims, typically across the world, the claims which on the own damage side, which are most damaging for insurance companies, are hail. And having lived in Germany, I can tell you that I have seen some hail damages where hail, yeah, only what I would call in
Yeah,
Hindi, that of the size of tennis balls fall.
yeah,
And I remember in Allianz, now don't remember the year, I saw this like out of my window. And you realize that any car which is outside will have huge dents. So
right,
when you actually get these hails, and there are so many cars, and cars are typically parked in open, including in some dealerships, that is actually the single biggest risk you have. If you look at on the flood side, let me just give you some examples. Chennai floods was quite severe for motor. Recently, we saw Calcutta. Delhi was pretty bad last year. Prior to that, we have seen claims in Bangalore, where I think the most prominent sort of a society where all the rich
yeah,
people live, it got flooded, and people saw that like really expensive cars being completely being underwater. So we have seen a lot of claims in floods. I think hail is not very popular in India, but hail is where these damages happen. But even if you assume that on an average, if the average claim size today in case of say car is roughly about 25,000 rupees of accidents, and even if a hail happens, it will happen in a particular city like flood or some
right,
area. And even if you get 10,000, 50,000, 40,000 cards with hail damages, how much will it cost? In Calcutta, I would say the total motor vehicle claims due to this flood would have exceeded, I would say, about 400 crores, definitely.
right,
300 to 400 crores. It's not a small event for motor own damage. Lastly, the premium rates we have in India, they are the lowest in the world on own damage.
right.
So if you start seeing those kind of claims or events happening, then you'll also see premium rates going up. So
Got
I think in India, the biggest issue is floods. And
it.
within floods, it is more about commercial establishments rather than vehicles, which are concerning.
Got it. Got it. On that note, Kamesh, thank you so much. This was a really insightful discussion. It was like a masterclass on insurance. And you got insights on risk management to building a business from scratch and on the industry as a whole, which was extremely helpful. So thank you for giving us time. It was great having you here on the webinar.
Pleasure, Tej. Thanks for having me. Bye bye.
Thank you. So, guys, we will continue with our Kings of Capital webinar, and we'll give you an update on the portfolio and what we are seeing in the financial services space. Keshav will beam up the slides and we'll discuss both portfolio performance, the way ahead, and what we have done so far, where we were right, where we missed out on opportunities, and where we were wrong. So performance, looking at now the last couple of years, we've caught up versus the index. 22, 23 were the difficult years. Now, if you look at 1 year performance, we are a couple of percentage points better. This is post fee, post expenses. The last 12 months for the broader market has actually been difficult. So at about 11.5% returns, Nifty is at about 10%, but if you look at BSC mid cap index or BSC small cap index, there's been a lot of pain over here. Some of the data that we've seen, market as a whole, the median stock is down anywhere around 20 to 25%. So the portfolio has held up pretty well. This is a factor of our focus on quality, valuations, financial services as a whole, large caps especially have held up. Um, Similar story in the 2 year space. In the 3 year period, also, post fee, post expenses, we are just about 1 percentage point, 1.5 percentage point of the index. So we've, I think, caught up. The PSU rally during 22, 23 was something where we had missed out. There were some misses on our end as well, where we were not trim stocks on valuations during 22-23, the likes of say Bajaj Finance or a Kotak. But I think that is behind us. If we were to look at the last 3 years now versus the Nifty and Bank Nifty, we're broadly there. So that's on portfolio performance. We have still some work to do on the 5-year and since inception. We can go to the next slide, Keshav. So, like I said, if you were to look at the median returns of large cap funds, of flexi cap funds, and of small cap funds, we're significantly better. So, we are actually about 12 to 13 percentage points better than small cap funds. It's a relevant comparison because about 30 to 50% of incremental capital is still going to small cap funds in India. If you were to look at industry data, about a third of incremental money is maybe going to small cap funds. About half of total money in incremental terms is going to small and mid cap funds. We are better off than even flexi cap and large cap funds. We are better off than even the large cap funds by about 3 to 5 percentage points. So 7% versus 11% of the last year. Versus BFSI specifically, which is in itself over the last 2-3 years a large category. It's I think about 45,000 crores of AUM which resides in BFSI funds. We are about 2.5 percentage points worse off than BFSI funds. We'll cover that in the next slide. Keshav, if you can go to the next slide and cover that off.
Yeah. This is the slide that we show to you all every time. I'll just refresh what is it. We basically divide the whole BFSI sector into about 72 odd stocks. And those 72 stocks are then divided into 10 different categories. And the reason we do it because we've articulated multiple times both the fundamental performance as well as the stock performance, both on earnings as well as stock prices, move very differently within the BFSI bucket. So a general insurance company would have very different metrics versus a bank and versus a microfinance company. So looking at the whole sector with one view kind of doesn't do justice. So that's the reason why I look at separately. If you look at over the last 1 year, KCP has delivered post fees, post expenses about 11.5%. Now, if I were to bifurcate that return, I think the bulk of returns that we made came from multi-product NBFCs. So Bajaj Finance is up about 50 odd percent in the last 1 year. Chola is up 40% in the last 1 year. So that bucket of multi-product NBFCs and vehicle financiers that you are seeing on the extreme left side of this chart continues to do well. On the regional bank side, you would all know we own City Union Bank. That again is up 50 odd percent in the last 1 year. So the allocation of about 40 odd percent in this bucket, and that did really well for us. That gave us healthy returns. The second bucket where we have a large sum of money allocated is private sector banks, top four. This again form about 35% of the portfolio. That has given about low single digit returns, low double digit returns, 10-12%. So that has helped. The areas that we have allocated money and not been able to make a lot of money is general insurance and cash management. Cash management, we've had a significant drag. We own CMS, which is down 30-35% in the last 1 year. So that's the area, and some part of rating agencies. Rating agencies broadly have been flat over the last 1 year, despite earnings growing at about 15-18%. But stocks have been range bound, but that's okay given how the market has been. But cash management is one area that we have seen severe drawdowns, and general insurance as a space, be it Lombard or Digit, the stock performance has been average over the last 1 year. So that's the way I would sum up. I think our allocation in multi-product NBFCs, vehicle financiers, regional banks, top four private sector banks. I think as a sector they've done well, and within that, the stocks that we have allocated money to, that continues to do well. Gold financiers have had a very good run. Gold price itself is up 50-60% in the last 1 year. I won't say we've been able to capture the whole of 80-90% upside that has come in Muthoot, but we've been able to capture some part of it. It's been part of our portfolio for quite some time now. So that's the way I would explain the last 1 year. If you kind of think about large cap, mid cap, small cap, I think we've continued to be largely focused towards large cap over time, as Tej kind of articulated in the last slide. Since we are seeing small cap returns being very benign over the last 15 to 18 odd months, incrementally we are allocating money because we are seeing now stocks having gone for both time correction and absolute correction, and we are seeing some opportunities. So we are moving money, gradually from large caps to mid and small caps wherever we are seeing that opportunity. Yeah, so that's the way I would summarize. Lastly, coming to the portfolio, this is the slide that we show every time. If you look at the portfolio metrics, given how the slowdown that we have seen in overall corporate earnings, I think Nifty earnings are barely growing at single digit for the last 4 to 5 quarters. In that context, Kings of Capital continues to do well. We are just about 10-12% earnings growth if you look at over the last 4 quarters. Given the context, as I said, Nifty earnings would have grown at about 5%. So we are still 2x the growth of the industry. But for that, we're not paying very high price to earnings multiples. So if you look at the trailing price to earnings of Nifty, that would be at best about 18 to 20 times, and we are paying about 23 times. But given the quality, given the growth that we own, I think we have reasonable margin of safety. Coming to where we think earnings, if you look at the last 4 quarters, now the base effect is in our favor. If you look at effective Q3 FY25, even in the base quarters, the earnings growth was soft. So our sense is Q3 and at best Q4, we will go back to 18 to 20% earnings. So our internal forecast kind of suggests high teens growth for the portfolio in F27. If you look at even Bloomberg estimates on our numbers, on our companies, we are looking at earnings growth accelerating from here on. And in that context, given the valuations where this is, and this is 23 times trailing at the end of September, October, November, December has actually been pretty bad for the markets. So to that extent, we are far more cheaper. My sense is we would be trading at about 17, 18 times on a forward basis for this portfolio, which given an earnings growth expectation of, high teens, is a reasonably good time to allocate incremental money to Kings of Capital. Tej, if you want to add.
Yeah, I think if you were to again think of Kings of Capital versus the market, the portfolio is available at a multiple on FY27 basis at about 18 to 19 times, which is similar to the market, with return on equity better than the market and earnings growth again better than the market. So given the quality of the portfolio, our top holdings today, for example, would continue to be a HDFC or a Bajaj or a Chola. And versus these companies, the market valuations of these companies in the market is similar. HDFC Bank and the market's valuation would be similar. Chola and market's valuation would not be very different. Similarly, as a portfolio as a whole, if you were to consider the portfolio's valuation and the market's valuation, it's quite similar, despite our portfolio's fundamentals being much better than the market. So we think this is a good time to allocate capital to the portfolio. We've been saying this for the past 12 to 18 months, and you can see the results of that if we were to allocate capital to things at market multiples with better fundamentals, you would eventually see results which are better than the market, which is why you see versus a flexi cap, median flexi cap returns, the portfolio has done about 3 to 4 percentage points better than over the past 12 months. Simply because we've been disciplined on valuations, been a bit contrarian, allocated to the right places at the right time. So we think we're continuing to do that. Regulatory environment is benign. Growth is likely to pick up. Interest rates are falling. And portfolio companies are starting to do better, is what we think. Therefore, we think we're poised to do better than the market on a relative basis. We're poised to do 18 to 20% earnings growth. And from this point on, even absolute returns look to be quite promising. So on that note, we'll conclude the webinar. Thanks for listening in and thanks for spending the time. Thank you.